So this video is going to be all about stock prices. Now, I want to connect how stock prices relate to other things, so it's not just about how to calculate a stock price. For understanding that kind of stuff, there's lots of videos and resources on the internet to find out about how stock prices work. But basically, to make a really quick little introduction, basically a stock price is the value of a company. How do you find out the value of a company? Well, just as a quick example, let's say you have a company that makes something like in a plant of some sort. So let's say the actual building and the property and stuff is worth, let's say, $1 million. Let's say the machinery is worth about $1 million. That's $2 million worth of stuff, right? Now let's say they have about $500,000 worth of liabilities. Let's say that would be like a mortgage on the property, maybe some money that they owe to vendors and stuff like that. That brings the $2 million down to $1.5 million, right? And then let's say they have 1 million shares that are out there. Then basically the worth there is about $1.50 per share, because you have $1.50 or $1.50 times 1 million gives you $1.5 million. That's just though for the price of the actual liquidation value of a company. Often the actual earnings of a company, like how much profit a company makes, is really what dictates the price of a stock. So let's say a company earns $10 million worth of profit, and if there's $1 million worth of shares, those shares might be worth $10 a share, just because they're actually rating the fact that that company is worth $10 million because of what it earns. Maybe more, maybe it's $20 a share. And ultimately there's lots of different ways you can calculate it, and there's different industries that have different, it's called the price to earnings ratio. So some industries, they'll actually give a higher valuation to a company because of future growth. A lot of times in high tech, that's what happens. The company is going to be trading higher than, let's say, what it's intrinsically worth, because people expect more in the future. That, oh, they're going to be worth so much more in the future, so I'll pay more now because it'll be worth that much more later anyways. So ultimately, when you're looking at what a stock price is and what it's worth, it's a lot of it has to do with that market action. And I made a previous video about market prices. It's ultimately worth what someone's willing to pay for it. And what someone's willing to pay for it, that has to do with their beliefs and their perceptions. If someone has a belief that this company is amazing, it's going to do amazing things in the future, they're going to give it a higher value than someone who believes that the company's garbage and it's doing terrible things and it's going downhill. Also, a perception, like what you understand of a company. If there's a scandal that comes out, ahead of the scandal, people did not perceive anything wrong with the company. Once a scandal pops up, now the perception is different because there's new information, and that could also change beliefs. So ultimately, those are all these different things that affect the value of a stock. So stock prices can be pretty volatile. They go up and down all the time. And that's because different people have different expectations for what's going to happen with a company and with the price of the stock as well. Some people are speculating on whether the price is going to go up and down. And so then that could even affect things. People get excited and say, oh, the stock's going to go up. Other people might buy and actually increase the price of the stock, making the stock go up, which could have nothing to do with the actual earnings or what the company itself did. It's just people's excitement. On the same note, people get scared of something, like, oh my gosh, did you hear that this happened with the CEO or something? It could be nothing, but it could be enough that it could scare people into going, oh my gosh, and then they sell their position because they don't want to be involved if that stock price goes down, and that can drop the prices of the stock dramatically. So sometimes you'll see stocks yo-yo up and down for no reason, and that's ultimately kind of what drives that kind of thing. So there's different things that motivate different people to buy different stocks. For some people, it could be what they get from it in terms of earnings. So if it's paying dividends, some people are looking for a dividend. And so let's say if the price of a share deems that the dividend works out to be about a 5% annual return, then for some people, they see that and say, you know what, this company's pretty secure. I feel good about getting 5% per year on this because I'd only be getting, let's say, 1% in my savings account in my bank. Other people would say, you know what, the stock's too risky. It's not worth it unless I'm making 10% at least. Or some people look at a combination of whether the stock itself is growing, the actual value of the stock, and the dividend itself. Some people just want the price of the stock to go up because they feel that that gain is worth more because it might happen faster. Everyone has a different opinion of what they think it's worth, and that's where it comes into their beliefs or their perceptions of a company. I mean, here in Canada we have Home Capital Group, so a company that's had some recent scandals happening, has to do with some fraud on different people that are applying for mortgages because it's a mortgage company. So it's interesting to just see how before this scandal and before it even happened, let's say, people might have had a lot of confidence in this company. They could have had a perception that it's a very secure company, despite that it's not like the top lender in the sense it's taken all the, you know, the best clients, but because it has to take some people that don't get, you know, approved by other banks and stuff, then they might get more interest, so they might earn a better return on their money. And so for some people, if they're paying out a good dividend, they might feel that it's a good company, it's worth some stuff. I'm not here to pass judgment on what I think it's worth or what should or should have happened. I'm just going to say what I see has happened. People then heard about this fraud situation and then they suddenly lost confidence in the company, thinking, okay, whether it be that they don't think the actual mortgages that are being held are worth anything, or if they don't believe in the actual management. For both of those reasons, people pulled out. Some people pulled out their actual money that they had in their savings accounts with that company. And so then that caused a bank run, making even more of an issue. You know, it kind of accelerated to the situation. People just being worried about the company itself pulled out of their stock ownership, which dropped the price of the stock, like more than half. I think it was like 70% or something that it dropped. Because even if the company on the books is worth more, if they don't believe it's going to stay at that value, they want their money out. And also, if people believe it's going to go down, they want to capture their money often before it goes down, so they'll sell while they think it's high. But again, we don't always know what's going to happen in the future with any company. We can only have what our own beliefs are as a result of our perception, what we perceive is going on. So as the stock price is going down and people aren't believing so much in this company, people who had their deposits, their bank accounts with them, even though I think it was federally insured deposits up to $100,000 anyways, a lot of people still pulled out their money because they don't want to be caught up in that mess. And that made the company look even worse. It made it harder on their books for them to actually have the liquidity that's necessary for a financial institution. So after that, you know, there was some, you know, loan that they got, and there's different stuff that you can look into as to what happened. But you can see how just the very fact that when the beliefs changed about a company, it changed what people believe it to be valued, what someone is willing to pay for it. There's people still buying that stock because some people think, oh, it's worth that now, I'll buy it, it's cheap now. Other people are thinking, you know what, it's still overvalued, it's not worth it, I want to sell it. It goes back and forth, everyone's different. People's beliefs in their own confidence in the company is what made people start creating basically a bank run where they started pulling out their deposits. So it's just interesting to see how if that situation with the news hadn't come out, you know, maybe the company, if it was not doing well, it's wrong, of course, for people not to be in the know, especially when it's a publicly traded company. But if people didn't know and people were oblivious to that, people could have actually thought the company and the stocks were worth even more than it was. They could have said, oh yeah, this thing's growing, it's great. But is that really the truth? It's only based on your perception of what's happening or your belief of what you think. You know, once that information changes, when the news comes out, which is important to have a fair market, then that's when things change and then the prices change. So it's just interesting to understand how the price of a company can be changed really easily by something like, you know, the PR out there, basically press releases, like what's new, what's the news, if the company earned more than before or if it earned less, if something's going on with the management, if people, you know, have more or less confidence in who's running the show. Even something as simple as, you know, if people have a half decent confidence in the company, like I was saying before, if it's paying a good dividend, maybe it's paying 10% and no other companies are really paying that much, the price of the stock could actually go up until it ends up evening out around maybe 7% or something because people are paying a premium to earn more dividends. That might be the only reason why the stock goes up. You know, it's kind of crazy in the sense that sometimes you don't even know why prices fluctuate. But ultimately it comes down to what people believe something is worth, whether it be in an aggregate, like all the shareholders or the whole, you know, let's say group of people that live in a situation where they are capable of making an actual purchase, because people are influenced by their friends. If their friends are saying, "Oh yeah, that company's terrible, you should sell that," some people are influenced by that. They might sell just because their friends said it was no good, or it could be their advisor. You should always make sure you're, especially if you're in directly dealing with investments, you should make sure you have a good financial advisor to help you make your right decisions that are right for you, because some people can weather out a storm and hold on to stuff when other people could not. Some people will buy in when the prices are low, even if it's risky, because they see a potential gain. You don't know what your situation is until you've really examined it. So I encourage you to make sure that you have the right, advice and the right counsel with regards to your finances, but ultimately keep in mind that no matter what's happening and what anyone's telling you, the prices are dictated by not only what you believe, but what everyone as a whole on average thinks. And that's dictated by what they know. So it's just food for thought out there. And I hope you enjoyed this particular adventure of connecting the dots with the WAS.